Hello, Andrew. How is the weather on your side of the world?
It's very nice in London. Hi, Dominique, and excited very much to record another kind of week ahead. So
Indeed.
let's kind of, and again, so this is London afternoon, March 26th. Obviously, again, a very interesting week. I guess this week particularly was the week of the 50 basis point hikes talk. So why don't you kick off with your thoughts on the past week, and then we'll dive into the kind of week ahead.
Oh, the past week. Well, it looks like the Fed is starting to do the right thing. I mean, by that, I've looked at the data last week on past Fed tightening cycle. And the bottom line is that we are in for a recession. We are too far behind the curve. I've looked at the 9 tightening cycles since 1965. Whenever the Fed started as far behind the curve as we are, there was always a recession. However, we can have a short recession or a long recession because what's clear is that the highest cost in terms of lost output and lost employment, and the longest recessions happened when the Fed took its time tightening. And the best example of that was the recession of the early 80s, where the Fed basically started tightening in 1997 and really got its act together and enough guts to tighten for good only in 81 or late 1980, early 81, which led to the deepest, longest, nastiest recession in the US before the GFC. So after the
So
FOMC,
yeah, just to go on that real quick, for not too much time, but so basically, I heard you saying during the week, Volcker, everyone's saying what a great central bank governor he is and how aggressive he was, but in reality, he was actually too slow to react, or the Federal Reserve was too slow to react initially, and he had to raise rates so much at that point because they were too slow.
exactly. So to be fair to him, he came on the scene as chair in 79. Before that, he was president of the New York Fed. But initially, so he came in 79, it took him 2 years to really tap the brake. And I think what made the difference is that Reagan won the 1979 election. If really this was a conservative president, wanted to really end inflation. So perhaps that's what emboldened the Fed. But as an institution, yeah, I mean, the Fed did not exactly cover itself in glory with the way it handled the oil prices. So I was starting to despair after the FOMC that we were in for a repeat of that episode. And miracles of miracles, this week, Chair Powell gave a speech which was very hawkish. The Q&A was very hawkish, and I think it was all arranged in advance. Given the tone, the exchange, he's apparently good friend with the interviewer. And yes, finally, 50 basis point in May is in the works. After the speech from Chair Powell, we had a few doves talking. Sorry, my French accent is worse on Saturday morning.
We got it. Yeah.
We had doves, we had Williams, we had doves of doves, Evans from the Chicago Fed, we had Daly from the San Francisco Fed. And yes, they've finally realized they are a bit behind the curve and they are not opposed to the 50 basis points hike. So, these early days, I think the 50 in May is probably in the bag.
Yeah,
The question is what happens in June, because the Fed is you just wait for this CPI print 2 weeks from now. There is a good chance it could be about 1%, simply because the increase in gas prices at the pump is, I think, the highest on record. Anyway, where I live in California, we have the most expensive gas in the US. And each time I fill up my car, it's more expensive. So this is going to be a sort of a psychological threshold for the FOMC. I mean, if it happens, which I think is quite likely. So there is some hope that finally the Fed gets it. They have to do something before, they end up in a situation like the late 1970s, where they take so much time that in the end they really have to hike aggressively, and then the output costs are really high.
What do you think? Some people think they're already in that position, but let's assume they're trying to do the right thing from here. What do you think about this? Because you've been pretty far out front. Obviously, you thought they should have done 50 in March, but what do you think about the like 4 straight 50 basis point hikes? Can you see that? I think it was like Citi or something like that. Yeah.
4 straight. I mean, you don't want to kill the market. Unfortunately, the Fed has been feeding all this liquidity, QE, that does nothing for the real economy, but sends the market on a high. So you want to catch up to the curve, but not in such a way that, the market collapses and you have to reverse what you are doing. So
when do you think you'll start seeing like a real, if you think even if it's a short recession, when would those numbers start showing up? We haven't discussed this before. I'm just curious. Yeah.
So, I mean, in terms of, the absolute criteria is GDP turning negative quarter on quarter. And I've looked at the past 9 times they hiked, and the lag between the first hike and the first negative GDP print is between 6 and 9 quarters. And I think in this case, even worse, 6 and 15 quarters. And so in this case, I think it's more likely to be 6, possibly even less, because the economy is much less strong coming into the hiking cycle than people assume. We have no increase in household income. It's actually falling in real terms. The thing that's supporting consumption is a decline in the savings rate, but I think that's it. Now we are back to pre-pandemic savings.
Do you think there's a chance we see the numbers starting to roll over like by September? Because if not, they could be on a path of 4 straight 50 basis point hikes.
Yeah.
Oh, you also think the midterms that maybe that they won't really go that they'll temper a little bit, which is historically what the Fed has done.
That's true. But I mean, even in terms of, I think, central banking is an art. It's not a science. Yes, you have the 400 PhD economists with their, stochastic general, I forgot. Dynamic stochastic general equilibrium model, so a lot of code. But the reality is that when you do something and you start so far behind the curve, you want to go hard, like do twice 50, see what happens, are there stress points, and then you can do more. So 450 in a row, it sounds a bit extreme to me, but I would do 2 and then, do 25 or pause and see what's, who has survived. And then decide on what comes next. But I don't think, given how far the Fed is behind the curve, there is no magic recipe. They have to be very careful that they don't overdo it and then end up crashing the
Right. Okay. That last question before I was just going to say last question before we move on.
No, I was just going to say it's not so much about negative growth, because unfortunately that's where we will end up. It's more about financial stability.
There's other things, of course.
I mean, we've seen what happened to the commodities traders, right? There must be other pockets of fragility that we don't know about, and I think that's a key reason for not doing 54 times in a row.
Yeah. Yeah. I mean, one thing, I mean, I don't think it's that big in the US, but I'm sure there's a lot of money that's been lent over the last 2 years to buy used cars. And it's been great because used car prices have gone up so much. But if people can't make those payments, um, and used prices stop going up, so the collateral to pay for it, like, I don't know, that to me, that could be actually one of the issues that's out there. But a quick one, before we look ahead. Durable goods, how important was that number this past week?
So it's important, kind of, to me. I mean, the US economy is 70% consumption, and durable good, especially capital goods order or shipment, have a good correlation with capex, especially equipment capex. So it's an important one, but it's disappointed, especially the capex related parts. But you want to put it in context. So, like, for instance, talking about what's coming next week, the NFP, of course.
Yeah. Let's segue into because you're saying, I'm reading your piece, which everyone should read. It's obviously a pretty data heavy week coming up. Yeah.
Definitely.
So what are the things to look out for? What's your expectations on them?
So on the NFP, I think the street is too optimistic on the headline number, because what they have, which I believe is about 400 something, basically assumes a constant, like, 3 months average. And I think the economy is already starting to weaken. And I would take the durable good number as a sort of an early sign of that. Also, if you look at things like consumer confidence, there is an index of job plentiful minus job hard to find. It started to fall. You look at the ISM, the services ISM employment, it's falling. It's been falling a lot. So my economist nose is twitching, telling me that things are perhaps not as rosy as Chair Powell is telling us. I think one of the issues for Chair Powell is that it's difficult for him to tell people that they are going to have a recession. And that may be why he tends to overplay the economy's strength, the strength of the economy. So in terms of the NFP, I expect negative surprise. I also expect the nominal wage growth to be lower than the 0.4% expected by the market, for the same reasons that the labor market is weakening. And one of the things, that really surprises me, last NFP, wages did not increase, and no one is talking about that. And people are still talking about inflation risk. And
that was like a month ago. That was like, decades ago in today's world. I think everyone was just like so excited. The Fed's at it, maybe not that far behind. It was good numbers, but not big wage growth. And now 3-4 weeks later, we're in a very different world where, like, inflation is going to be 10%, and so it'd be interesting to see how the market takes a disappointment or on the wage growth. Yeah, I agree. That'd be a super important number, probably more important than the headline number.
Yeah. Totally. So there is that. And then, of course, we get the PC. And on the PC, the number that's really important is the trimmed mean PC. It's basically PC where you ignore items with large price changes. And given the instability in inflation caused by the supply shock, this is a number we want to look at. Unfortunately, that number is released about 2 or 3 hours, more like 3 or 4, after the release of the headline number, because it's produced by the Dallas Fed. And those guys, not only they are 1 hour behind New York in terms of time zone, but they are definitely not on market participant schedule. So the sense of urgency is not there. So we'll get that mid-morning East Coast time, but it's a really important number. It's the one to look at. I suspect it will be down a little bit over last month because it's quite correlated with the CPI, and the trim mean CPI was down, but still very elevated. So that's my second number. And the third one, of course, my favorite.
So what number you agree with the consensus of 0.4?
Yeah, but
Okay.
I agree with the 0.4 core month on month. I don't think core is giving much of a sense of the trend. That's why I look to the trimmed mean.
And the trim mean you're expecting?
Around 6 or 7, but we'll see.
Okay.
We shall see.
Okay.
And then the interesting, I mean, perhaps in terms of trends, the more telling data of the week is a personal income and spending. And I think, on personal income and spending, the consensus is 0.5, which is less than inflation, which, makes sense. This is what we've had for the past 4 or 5 months. The more interesting number in there is the savings rate, because the savings rate right now is about 6.5%, so a full percentage point lower than before the pandemic. And I expect it to stabilize. And if it stabilizes, then it means that consumption is going to be driven mainly by income, and real income is falling. And especially if, the wage growth disappoints, it will mean that the trend for real income growth is even weaker. And so we could, start getting this. I would treat this as a sign that the economy is weakening, and that this negative GDP print I'm expecting for next year could come earlier, say Q1 next year.
Okay. And if that savings rate is even lower than the market expects, that means that there's even less kind of dry powder from the consumer.
Definitely. And I suspect what's going on at the moment is that low-income consumers who got an enormous boost from the government with all the money, and also the unemployment insurance, they've taken a break from the labor market, and they're probably living off their savings. And I think the savings are being depleted, which is why we've seen a recovery in participation. So I think this savings rate that we are seeing, which is overall positive, is probably an average of this negative savings from low-income workers and positive savings from high-income workers.
Yeah. Okay. And then things like consumer confidence. I guess a lot of stuff's coming out. Is it interesting? Why is consumer confidence so? I mean, I think the same thing in the UK. It's like super low, despite is it just because of negative real wage growth?
Yes, I think this is a big part. The consumer confidence we are getting this week is a conference board, which is not as sensitive to inflation as U of Michigan. So inflation plays less of a role, but it's still there. Yeah, I mean, it basically, when you have that low consumer confidence, it tells you that the economy is not as strong and as rosy as you would think, looking at the equity market, for instance.
Yeah. Okay. Okay. Anything else investors should think about for the coming week?
Some developments in the Ukraine, with Russia perhaps signaling that it might, just plant its flag on the eastern part of Ukraine and declare victory. And so perhaps some form of a standstill, maybe not even a formal ceasefire, but a sort of a stasis in the war, without the suspension of sanctions, which is my base case scenario, and which is why I expect to have to continue to pay these absurd prices for whenever I fill up my car.
Right. Yeah, so as long as the sanctions stay in place, um, obviously there's always the chance that there's something between, Saudis, UAE increasing production, or the Iran nuclear deal getting reworked, or obviously Venezuela's smaller. But I'm in your camp. I don't really see just uh, an end of the sanctions in the near term, which is really like the biggest issue. And certainly for energy prices, fertilizer prices, and a lot of which would feed into inflation. Yeah, just as we were saying, as we're talking now, I thought I saw something about Biden saying he can't see Putin staying in power, or should stay in power after this. And if that's true, that's a pretty big deal. So let's see. I mean, maybe he's just trying to talk tough, but that's pretty serious.
Well, I certainly do not want to question the geopolitical wisdom of our president, but if this is the actual objective, regime change in Russia, it suggests the conflict in the Ukraine and the sanctions are going to last a long time.
Yeah,
And in terms of the relief we can expect from Venezuela or Iran, as you said, Venezuela is small. Iran, it's not clear how much of a net increase to supply we would really have, because they've been apparently quietly selling some oil to China.
yeah, at discounted prices, absolutely. And again, it will. I mean, no matter what, it's creating even discussions, geopolitical issues with Saudis, UAE. Then there's also the question of, many countries now feeling that they need a nuclear deterrent, with seeing what's happened. So anyway, interesting week as always. Awesome stuff. Want to wish everyone good luck this week, and as always, please reach out. We had one of our first kind of more for our Prime members meet up in London this past week, which was great. We got some great feedback, great color. Really appreciate the community feel that it feels like we're building. So, for our pro clients, we're definitely going to make an effort to hopefully try and see as much people in person in the next month or two. I'll be in South Florida for a few weeks. Certainly, we have a few clients down there. Try and see them. There are clients in London, but our clients in New York and Asia, we're also going to try and set up trips certainly in the next couple of months. So, good luck, everyone, and have a great weekend.